Finally, the moment we've all been waiting for, or at least those of us who follow trend and look at markets objectively. And don't worry for the non-believers, we will cover some important nuances, but they're actually going to validate the move higher in markets, not really disagree with what we've seen thus far this week. So, as always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. Let's kick things off here on the good old-fashioned SPY daily time frame chart. What do we see from a trend perspective? Of course, we're in a daily uptrend, lows, higher lows, and as of the Monday session, it looks to me like we have the next set of higher lows in place here. We also recall that we're pulling back from a higher high. The market could afford the higher low. All things equal, very healthy place for the market to turn around at a known area of structure and above the prior breakout point. This was our line in the sand we discussed on the weekend update at 429.25. A couple of other things here happening on the daily time frame chart. We did stop one time framing in the downward direction. One time framing refers to consistently producing lower highs and lower lows on the bar to bar count. Notice that we had 5 days of one time framing lower. Tuesday breaks that, which is a bullish phenomenon. Obviously, you could think of this as a micro trend channel. We're above the top of that resistance portion. That is a bullish indication. Today's consolidation is in the upper 50% of the Tuesday breakout range. That also does strike me as a healthy indication. Now, we did struggle at the prior 2-bar highs, the equal highs back here. You can see Tuesday's high goes right to it, and today we print a little bit of an upper wick, but to get more granular, I think we do ourselves a favor and move on down to the hourly time frame chart and start discussing the nuances that are here. So, a couple of notes. As the breakdown was unfolding, it was a very orderly pullback. This is one of the things that we had been reiterating in the morning live streams. There was not outright panic sell. It was very mild drift in the downward direction. You'll also notice that we have repaired the thin structure. You could think of this as almost like a low volume void. If I were to throw a volume profile on it, there's not a lot of trading activity that happened there, so that has been repaired, and we've found support off of a logical level. That's where the rally really came from on the Tuesday session. You could also think of this very loosely as a falling wedge that has broken in the upward direction to start to resume the daily trend, which, as we know, is up. A couple of other things pattern-wise. We know that the neckline of the oh-so-obvious head and shoulders from back here has been recaptured, right? So we were underneath it, and we did produce a lower high below it on the Friday of last week's session, but Tuesday had no problem breaking above, and on today's session, this is important, not only did we hold the 50% mark of the Tuesday breakout range, but you can see multiple lows that came in and retested the neckline from the top side down, providing it, or proving really, that it is turning into newfound support. Now, this does mean we have a poor low, and we will see that on the market profile in just a moment, but for now, start to flip the script in your mind. Just like we had a beautiful head and shoulders here, can we not have a beautiful inverted head and shoulders here? And the neckline would now be at 436.75. So it's not so much that we need to go to the measured move of any particular pattern, but it tells us the inflection point that we need to be monitoring if the trend is truly going to reverse. And in this case, for the SPY hourly chart to truly produce I would say it's already in a beginning uptrend here with lows, higher lows, but as soon as we can produce a higher high above the equal high, aka that neckline, at 436.75, we're in business, and the target should start to become this gap close overhead. 438 closes up to 2 Fridays ago's low, and that number is going to be at 438.99. So only about $1's worth of move there, but notice it's right towards the upper edge of this week's expected move. We are headed into a shortened holiday week next week. I would keep expectations in check for massive upside continuation. I would not be gung-ho about the market making a full-blown rotation to the equal highs on the daily chart into the end of this week at 444. But nonetheless, on the hourly, you can see the bullish improvements that have been made. It would be irresponsible of me to not at least point out, though, that once again, on the daily, we saw this also. The upper wick of today's session has rejected the upper distribution. Remember that this Tuesday session, after the Monday holiday last week, it technically provided a double distribution on the market profile. We'll see that in a moment. We did fail to get above that and stay above that on today's session, but nonetheless, holding above the 434.50 does strike me as a key nuance. Let's take out our Fibonacci's and just point out some confluence levels. We know that this is the 61.8 here, so the more that we can hold and stay above, the less likely it becomes that we do see the full-blown retracement into the 429.25. What else do we have here? We can throw on our anchored VWAP. We've been monitoring this one for quite some time. Notice that we're tangled up around it and we technically close above it. I would really want to see some more proof for upside here, aka a break and higher low above the 436.75 on an intraday chart to really start to more confidently say that the anchored view app has resolved in the upward direction more firmly. What is the opening or what is this day here when the breakdown unfolds? This looks like the 16th. I just want to bump this forward and look at this together with you. If we jump that to the 16th, notice that, yeah, even coming from the high of this move in here, we are technically above that anchored view app as well, and we may as well anchor it to yesterday's low, which is going to be at the 27th. There we go. And you can see that this technically acted as support. We never got an hourly close underneath that anchored view app, which does strike me as a bullish indication. So with all of that said, we understand the psychology that's at play here, and we really have two key levels into the remainder of this week. Very simply put, it's basically the high and low of today's session, the two big arbiters of price. 434.50. As long as we're above it, I would think of this as bullish consolidation and a very healthy and strong recapture of the neckline of this hourly head and shoulders. You could think of that as cementing your daily high or low, as long as we're above 434.50. Breaks will be playable in the upward direction over 436.75 with targets at 438. And if we break down underneath 434.50, I would not be a proponent for grabbing shorts on the breakdown of that level. I think there's a very real possibility that we sweep these lows to repair the poor low. We'll see this on the market profile. And then if we come back into this range, it's game back on for the upside. The only short that's on the table here is if the market produces a lower high that looks like this below 434.50, in which case that would be fairly concerning on the daily time frame, noting that we would have to contend with this as a daily lower high. We're not there yet, but it is a potential threat that's worth acknowledging. To simplify things, two main numbers into the end of this week, 436.75, 434.50. I would lean on the bullish side of this pattern. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. For the most part, internals are bullish across the board. We have solid volume inflows on the week, getting close to the significant read as of Wednesday. We're sitting at 441 million. Significant is positive 500 million, so right there. And you'll notice that on the Tuesday breakout, we did see significant inflows for that specific day, getting up to our 300 million read on the individual session. If we look at the advanced decline line, very bullish across the board. Today's congestion or consolidation digestion day, I should call it, in the upper 50% of the Tuesday breakout range was paired with neutral internals, neutral but yet bullish cumulative tick. And once again, this is supportive of the break that we saw on Tuesday as well. The big takeaway here is really what unfolded on Monday. I want to be very, very clear about this, that Monday, as the drift lower was unfolding, you should not have been confident in any serious sell side activity out of the market when the internals look like this. Solid, I shouldn't call them, they're not impressive inflows, but they're definitely not bearish. The advanced decline line is very strong straight into the close, and the cumulative tick as well was really solid on that day. It was really just a couple of bad apples, Tesla and NVIDIA namely, that dragged on the Nasdaq side of things, tech being the heaviest weighted component of the S&P, kept the market from going sideways. But as soon as those very few names started to outperform, it was off to the races in the S&P, speaking to, or I should say, the internals really spoke to the fact that under the hood, aside from some heavy-weighted components in the S&P, Monday was actually a bullish day, and we'll see more evidence for this as we move through today's analysis. Market profile is always Exhibit B. If you're not familiar with this screen, I've got another tutorial for you in the top right-hand corner. Overall, what did value do over the course of this week? Here is Monday's value, here is Tuesday's value, and today is inside of value from Tuesday. Overall, the point of control was substantially higher, did close higher with price on Tuesday, which is a confirming indication. It's slightly lower on today's digestion day. As we pointed out on the hourly time frame chart of the SPY itself, we do have a poor low which could use some repair, but we do have decent excess at the highs, repairing the poor high from the Tuesday high of day session. The other thing I want to point out here is that Tuesday did not produce a classic P-shaped profile, and a P-shaped profile is always indicative of short squeeze, right? As a matter of fact, you can see a little bit of a lower distribution down here, which would speak to potential accumulation and not that this move was entirely made up of shorts getting squeezed. You would have to assume that at least a decent portion of them would be new money buyers based on this phenomenon of the sort of lower distribution forming down here. The last thing I would point out is once again just the idea that we have rejected the upper distribution of 2 Tuesdays ago. Remember, this was the day after the holiday. We spoke about this on that session. That's exactly where we found a high of day today. That number is roughly 44.30. If markets can get above 44.30, that would certainly be constructive for upside, and we would look to close that gap we were just talking about on the SPY. So you're currently looking at a screenshot of the S&P sector performance after the close on Tuesday's breakout day, and you'll notice that leading the pack is communications up 1.59%, XLK tech sector 1.56%, XLY consumer discretionary up 1.55%. The reason I wanted to illustrate this, the reason I took a snapshot, is just to prove that once again the move from Tuesday was fueled by the risk on sectors, even though when we look at the percent change of the weekly so far, as of Wednesday's close, we are seeing leadership, at least percentage-wise, out of real estate, energy, industrials, and then we see discretionary and communications is lower and XLK is lower. Don't get me wrong, these are still green sectors on the week, but I didn't want you to be misled by the percent change weekly here versus what actually took place on Tuesday. At the bottom of the barrel, even on the percent change of the week, the only red names are all D for defensive sectors, XLV healthcare, utilities, and consumer staples. Let's breeze through the structural charts and just make note that even though real estate is up the most in terms of percentage, is there any threat of leadership out of this chart? Absolutely not. We're still stuck in this sideways range, which seems to have been going on for quite some time now out of real estate. We'll see if something happens as rates potentially start to heat up with a potential hike into the remainder of this year. What's going on with energy? Again, any leadership issues here? Absolutely not. Playing sideways in the range, all good. XLI for industrials gave us the beautiful break retest and is now moving higher, so that's fantastic. Remember that this is technically, it's lighter weight, but it is certainly more of a risk on indication for the economy as a whole. 8% of the S&P 500. XLY, this one's a little bit concerning. It's worth spending some time on here. We've gone sideways in this balance range. We've even gobbled up an inverted hammer from the Monday session. Why was it that there was really a lack of follow through at these highs over the top of this range? You would think that, number one, anybody who's still involved short from Monday is going to start squeezing out with a stop over this high. Didn't happen. Or it would just entice new money buyers. So that's a little bit concerning here out of the XLY, kind of rejecting that 167.25. But from a trend perspective, anything worrying? Not really. Into the end of this week, if it does turn into a look above, and fail, we'll call a spade, and 163 will be the target. But in terms of big structural deficiencies, no, absolutely not. XLB materials, lightweight sector for the market, maybe threatening a break at the top there. That would just be helpful for the bull case, but it's not going to make or break it. XLC for communications, great higher low has been found here, starting to break over the top of the 4-day range, looking for the equal high to be produced. That is bullish. XLK, same idea, right? Higher low happening from here to here, respecting the top of the breakout range from in the past, and we're also above now that 170 level, looking for continuation in the upward direction. That is healthy for the broad market. I would only be concerned out of the XLK in the grand scheme of things on a big time lower high like this if we can break and produce a lower high back down underneath the 167.65. Anything that just consolidates out in here, I would still give it a chance and look for that rotation over time, keeping us bullish. The XLF still struggling, needs to produce more of an upside move. We've been tracking this for quite some time. It's stuck sideways at our level, right? We really wanted a stronger resolution of this number. Monday was honestly looking menacing with the inverted hammer rejecting it. Today, hammer closing right on it, 32.85. It's got to give us something more clear than this. It's got to resolve the potential retest of this neckline in a more firm manner. Is this going to be a higher low or is it not? Tell us one way or another, and that should start to inform some direction in the S&P. If it wants to cooperate, you better believe it's going to be a very powerful force for the bull case, already assuming that the XLK looks good, the XLC, XLY, all those heavier weight risk on sectors, they look great. If XLF wants to play nicely with its friends in the sandbox, good to go. You have to imagine that that's a bullish look. So watching that resolution again, 32.85, the hammer, inverted hammer, not a lot of clarity on the chart itself. You got to give that one a little bit of time to resolve there. XLV, healthcare, D for defensive, second heaviest weighted sector, inside bars. It's just contracting in here. I would say that the wicks would be indicative, obviously, of buyers stepping up at the same support point, but once again, that weakens the level more so than strengthening it. So if those buyers get called, basically, you're looking for a flush to test the low in here at 129. That could be bearish pressure pressure into the remainder of this week. What do we see out of the XLU? Any leadership issues here? No, this is D for defensive. It is moving lower. If there's any stocks that want to be not participating in this rally, utilities are, that's exactly what we want to see. Same thing with XLP consumer staples, sideways in this overall choppy range, trying to find maybe a little bit of a base here for a higher low. But again, no leadership issues. It is D for defensive. If anything's going to be lagging, really glad to see that it's utilities, staples, and even healthcare. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner on how to set it up. Let's keep it very brief. XLK looks great. It's consolidating. It's going sideways. That is a risk-on indication. Same thing, producing a new higher high today out of the XLY, risk-on indication. The red flag continues to be the XLF. That is nothing new. This ratio really needs to perk up if we're going to see a stronger move out of markets for continuation. Closest tie posture-wise to the XLK is the XLC, and you can certainly see it is perking up and still well above an upward sloping 50 SMA. Risk off remains off, risk off remains off, risk off remains off, and off here as well. If we take a look at something like the XLY over the XLP for growth versus value, making a new higher high. So not even, remember we were talking about, fantastic. We broke this prior high technically. We could very well afford a higher low pullback to find a low somewhere around 2.1. Didn't even need it. It just made a new higher high on today's session. Once again, speaking to the risk-on nature of this market. Here's the dollar putting in sideways consolidation basically underneath our 103.50 inflection point. This is helpful as long as the dollar can remain underneath that level. But if we take a look at something like the gold contract, it's really not all that confidence inspiring for the dollar to remain weak and low. If the gold contract is truly breaking down here, it started to break and fail that 1920 level on today's session. In theory, that puts upward pressure on the dollar and thus downward pressure out of equities down below. It's a relationship to monitor, but once again, this is one data point in the web of analysis that we spin when it comes to the S&P 500, and we're moving outside of S&P price action at this point in time as well. If we look at rates, nothing really new to report here, going sideways in the range, still looking for 36.40 to break down. That would be helpful for markets. If we get up and over 38.20, put on your thinking cap, probably not the most bullish look for the S&P. The Fed tracker tool is continuing to show more confidence in a 25 basis point rate hike in the next meeting, which once again is the 26th of July. But the most interesting thing that I think I could show you from this potential dashboard is that we already know we're expecting one hike and then a pause. We've already talked about as well how it's really the battle between 1 versus 2 rate hikes into the end of this year. Something that you can notice though, if you actually look beyond just the blue highlight, is that the odds of a hike, one more hike, are slightly increased, not to the point of being confident or more than 50%, obviously, but you get a 16.4 and then a 26.5. So basically what the market is forecasting as a back pocket situation is one more rate hike and then a pause into the end of this year. But the back pocket situation is one more rate hike, a pause, one more rate hike for that November meeting, and then a pause into the end of the year and potentially cuts after that into the early stages of 2024. Just something to keep an eye on. And I think that we'll get more sort of clarity around that as we get the PCE inflation numbers, which are scheduled to come out at 8:30 on Friday. So be very, very mindful of what the services inflation part of that PCE component looks like. If it continues to read hot, I would probably make the bet that you will probably see this start to creep even higher than just a 26.5% probability of a hike in the next meeting, pause, and then one more hike into the end of this year instead of just the one that the market's currently pricing in. How about the risk appetite charts? Remember that we're making a counter trend move in an overall downtrend. The TLT ratio to the SPY will only become concerning when the resistance trend line breaks there. Certainly not a threat as of right now. And I would just zoom in here to reiterate that as the market broke out on Tuesday, this ratio ticked lower, so no flight to safety out of the TLT bonds. The glaring one that I wanted to show you on today's session is the HYG. This is one of those nuances I was referring to in the intro that should make you be a pretty firm believer in the move higher that we saw. So there was a glaring bearish divergence that we were dealing with. We had the equal lows out of the S&P. It was the flush point of the neckline, basically the head and shoulders pattern, of course. This was concerning, right? So we swept those lows, but what did the HYG do? It's basically made an equal high, whereas the S&P has not even made an equal high. So if you're a non-believer in this rally, I mean, there's nothing going on, even in junk bonds, that would be like overly indicative of risk off sentiment with this massive reversal right back on up to the high. So that is worth pointing out. If we take a look at Bitcoin for all of the crypto fans out there, I would just point out that the rally from the BlackRock ETF announcement is holding firmly. It's not breaking back down through the thin structure. There was no like rug pull, sell the news type event, and that does speak to more risk on conditions for the financial markets. Market breadth perked up with the rally from Tuesday and is above the zero line in new highs versus lows. We did not make that threat for a deeper retracement. Remember, that's what we want to avoid. It's not that this has to be going to the moon. We want it to improve still, but it just wants to avoid big downdrafts, indicating that stocks are making new 52-week lows. If we take a look at something like the SPX A200R, similar comments here, rebounding off of the 50% mark. And this one is perhaps one of those important nuances that I would also pair with what took place on the Monday session, right? So Monday, as markets were pulling back in equities here, things weren't looking great with that week close. The SPX A50R, remember that this is a daily time frame chart from last Friday to Monday, technically made an uptick. Obviously, Tuesday's an uptick, and on today's consolidation, it's a mild downtick. But the big takeaway is that as Monday pulled back in the S&P, broadly speaking, the SPX A50R was actually improving. So once again, if you're a non-believer in this rally, I don't know, all of the data points are kind of stacked against you at this point in time. Even if we look at something like the RSP, the equal weight S&P 500, it didn't hold the key structure that we wanted the higher low to be put in around, but we did certainly find ourselves a higher low. There's no arguing with that, and now we're back above that level, producing a bullish 3-bar play on today's session. I will concede there's one chart, market breadth-wise, that would kind of say, be a little bit cautious of this rally, and that's the Dow sort of theory here. Industrials are still pulling back. They have not even made it for an equal high, whereas transports are off to the races down below. So a little bit of divergence here, absolutely. Maybe be a little bit cautious into the end of this week if you're really a Dow player, but everything else specific to the S&P has really spoken to being a believer in the rally, not so much a naysayer. VIX volatility is a non-issue. VVIX, volatility of volatility, is a non-issue. Volatility futures, for you purists, is a non-issue, moving into further contango, and very mild reads out of the one-day VIX. QQQ daily time frame chart has certainly started to find a little bit of a higher low from here to here, but notice that we did come in for the full retest of the breakout point from back here at 357.25, whereas the SPY found a higher low above the breakout point as an equivalent. Now, I'm not as convinced that the QQQ is as strong as the SPY, just noting that on Tuesday we were unable to breach the Monday high of day, and on today's session there is an upper wick that rejects or shows some signs of rejection above those equal highs. This is looking much more like a balance area that's forming instead of some sort of deeper pullback like what we saw in the SPY. So let's go to the hourly chart and build that game plan into the remainder of this week. First and foremost, let's address the upper wick from the daily bar. We can see that as 2 hourly inverted hammers here. And these are really significant because notice that they're back to back, and the second inverted hammer technically makes a higher high. So what does that tell us? At one point in time, the second inverted hammer was a solid green bodied bar. It was looking really great to just gobble up the upper wick of the preceding inverted hammer, and we would look for continuation into the ultimate target, 367.25. The fact that that reversed all the way back down towards the level and we go sideways into the close isn't really all that encouraging, especially when we note that once again, this is much more of a balance here. We've swept the lows, look below and fail, and we were trying to get continuation out of and above the balance. There was just no acceptance from the buyers above the top of that range. Now, it doesn't strike me that it's overly aggressive in the downward direction either, because the afternoon pullback, unlike the SPY, did not test the low of day, right? Obviously, the pullback here really went more towards the midpoint of today's range, and we've closed right on the top level of our sort of balance area in here. So what does that leave us with for the remainder of this week? I would still say that the buyers are making a stand here, and the daily chart is looking constructive. Just like in the SPY, we said, hey, just like we can have a head and shoulders, we can also have an inverted head and shoulders. And I would really carry that forward as a possibility into the end of this week. If we cannot resolve 364.25 higher into the Thursday and Friday session, I wouldn't think of it as the end of the world. And instead, I would just say, okay, maybe it's logical that we come in for a test here, confirm that this is the hourly higher low at 360.75. This prior support wants to act as newfound support once again. And then we have ourselves that inverted head and shoulders will look to be constructive over 364.25. Another reason why I don't think it's so clear-cut what the answer is to do yet at this level is because if we throw on the anchored view app from a couple of key inflection points, it's more than just one. We know that we have to bump this forward to the Monday breakout, so there we go. Notice that we're just tangled at the anchored view app. There was not a whole lot of resolution above, and there also wasn't a big rejection back down underneath with a lower high. So kind of P for patience as this level gets resolved from that perspective, and it goes further than that. If we drop this over to the 16th, which is going to be the top of the move over here, here, it's the same exact indication, right? The anchored VWAP for any sellers even at this point, they're kind of right at their break-even point if you have been short from the top of the move back here. But wait, there's even more. If we take at this and move it to the breakout point from the Tuesday session, there we go. Notice that the lower wicks, though, are supportive of the breakout from Tuesday. So overall, I think the name of the game out of the QQQ is to, if we drop into the Thursday session, that's fine. I would not go chasing shorts there. And instead, I would be looking for hammer candles down here, double bottoms, inverted head and shoulders on something like a 5-minute chart. You guys know the deal. If we do get straight up continuation, that's great. But now you want to see a higher low with proof above the top of the balance range here at 364.25. So this level really needs to resolve. Where's the concern on the daily time frame chart? It's if we flush through the 360.75 once again, the neckline of this area from back here, produce a lower high. Now all of a sudden this puts in jeopardy the daily trend with a big time daily lower high. We would be open to the idea of a daily trend reversal, but we're not there yet. Let's not get too far ahead of ourselves thinking about that as of right now. Let's take a look at the market internals for the Nasdaq side of things. Not nearly as strong on the Monday session. This once again was due to a couple of bad apples over in tech land, but we do see some solid moves and activity on the Tuesday session. Once again, Nasdaq not nearly as strong as the S&P in comparison to that Tuesday breakout day, right? So a little bit more skeptical of the Nasdaq based on what we're seeing here. I wouldn't be surprised, once again, with this, I'm going to say very, very loosely with big air quotes around this, with this, quote, relative weakness to the SPY. I wouldn't be surprised to see this sort of situation, which we were outlining, unfold into the remainder of this week, right? With those weak internals, maybe another test of 360.75, and then we'll look to see how that resolves in the upward direction. If we take a look at the market profile for the Nasdaq side of things, we can still say the same exact thing as what we talked about in the SPY. Accumulation down here. We did not close the point of control higher on the Tuesday session, nor did value shift higher, but on today's session, it definitively did move higher, as did the point of control. No poor low on today's session, no poor high on today's session. We did repair the Tuesday poor high, and if we scrunch this chart up, I would echo very similar things to the S&P with the rejection, once again, of the multiple Tuesdays ago upper distribution back here. That number is going to be 15,225. That's been the level we've been watching on the Nasdaq futures if you are a futures trader. So once again, I think this is much more of a patience play. The ES to me seems much stronger at this point. IWM Russell 2000 and the small caps round out the broad market here, and notice the very constructive hold for the higher low here above the top of the prior weekly balance range. 179 was the level. We also had confluence with the daily 200 SMA, 50 SMA was creeping higher as well, and if we throw on the anchored VWAPs anchored to all the major pivot points after the October low, there was massive confluence of support around this area. Now, it was not an easy trade to have confidence in, especially noting the inverted hammer from the Monday session. Think about the same concept we just talked about in the QQQ hourly chart, right? This at one point, solid green-bodied bar, new higher high, it reverses into the close for a fairly weak close. So not all that confident in the move, but just thinking about what this means for the broad market. Remember that small caps are somewhat of a risk-on, risk-off proxy. And the fact that they rallied here does strike me as, lending itself to being more of a believer in the rally that we've seen out of the S&P, not so much a naysayer. Now, the real work starts now out of the IWM. Why is that? Because, of course, we have to contend with this level producing a big-time lower high, rejecting the overhead supply from the failed daily bull flag back here. The number is 184.75. If we take it on down to an hourly time frame chart, this should be very, very clear, right? So, sure, the breakout was decent over the neckline of, you could call this sort of a inverted head and shoulders. That's fine. You'll notice that we even produced a higher low on today's session, testing it early in the morning, respecting 181.90 and closing extremely strong at the high. So I do think that the buyers remain in control in the driver's seat, but now is the true test. Are we going to reject 184.75 or will we accept above it? I'm not convinced that it's an easy long to take the break of that level, noting that we would be extended through the upper edge of the weekly expected move, and we're about to head into a shortened holiday trading week. You better bet that there's going to be a decent amount of traders just taking Friday off and enjoying something like a 5-day weekend, right? You get Friday, Saturday, Sunday, Monday's a half day, Tuesday the market's closed. I don't really think it's worth being aggressive on the Friday session. Just keep in mind, if this move does unfold, I would only be a believer if we get a higher low above the 184.75. Just a break above is not enough to really convert me over to the side of saying, hey, things are back to being fine and dandy out of the IWM. What else coincides with resistance at the 184.75? Well, lo and behold, it's that good old anchored view app. If you're not using this yet, check out the links down below in the description, tradebrigade.co/trading-scripts. You can pick this thing up for free. It doesn't cost anything. So if you anchor this to the high of the balance range, confluence of resistance, of course, if we anchor it back here, way back, I believe it was it the first or second? It's going to show me in a second here. What was the day here? Sorry for the back and forth. The 6th of June. So we got to go forward a couple days. One more. There we go. Anchored to this, once again, confluence of resistance, pointing that out as well. And we can also anchor it one last time here to the low of Tuesday, basically, which is the 27th. Thanks for bearing with me through the clicks. Just notice that we are above that anchored view up. So what does this mean? What is the game plan? We kind of just outlined it here. If we get above 184.75, we would be above this anchored view up from the Tuesday breakout. That is constructive, but I would only be a believer on higher lows above 184.75. If we reject this area, where's the next big downturn for the IWM and small caps? If we're going to see a larger breakdown, you have to imagine that if this is a daily lower high from here to here, the flush gets real aggressive through the equal low breakdown, and that puts us back inside of the weekly balance range back down here, right? So the big threat out of IWM is something that does this for a daily H pattern, and then we will certainly be very cautious, skeptical even, of the 179 on a retest. If we take a look at the market internals for the Russell over here, big shout out to David Ball in the comments section, corrected me the other day. This was set to the tick Q, so my apologies. Didn't really change the analysis, but it has been updated. Thank you for pointing that out. The ticks were flat on today's digestion. I wouldn't even call today digestion out of the Russell. It was actually more of an update, right? This was much more of an aggressive up move out of the Russell than what we saw in the S&Ps and even the QQQ. So the fact that this is flat in the internals cumulative tick, again, kind of skeptical at the upper edge of the weekly expected move and also that big resistance point overhead. But we should be believers in the Tuesday rally, Tuesday volume, Tuesday advanced decline line. It's really just the fact that I do think we could experience a pullback from the Russell off of 184.75, the retest of this overhead level. Apple kicks off the core list of companies, and man, this never gets old. Blue sky territories, $1.50, intraday levels that form overhead, incredibly bullish, new all-time highs here on today's session. Any pullbacks that unfold intraday, you're looking at 187.75. Let's go to the hourly, actually. Here we go. So anything that looks like this, 187.75 is good, as is 186.65. On the daily time frame chart, we can afford a higher low over 184.50, but be open to the idea that the hourly chart may provide a downside opportunity to get there with a lower high underneath 186.65. So as long as we're above 186.65, looking for bullish trades. If we're underneath, it's not Armageddon, but you can trade it for lower into the daily support of 184.50. Wanted to make that nuance very clear here. Next up is Netflix. What's going on with Netflix? We're still on the hourly time frame chart. Remember the double top neckline from back here? It did provide some resistance on today's session, but you have to give credit where credit is due. This hourly downtrend was substantial, one of the more substantial downtrends that we had across all of the mega cap tech cohort. The fact that we saw a gap into the midpoint of the choppy range, we got follow through, and the afternoon pullback did not get back down into the range, does strike me as being a fairly bullish takeaway. So what are we looking for here? Really, any higher lows above 426.85, be open to the idea of an hourly trend change and to retest the equal high here at 436.50. The bears only have something going on with a break back in and a lower high underneath the 426.85 level at this point after today's gap and go strength. What's going on with Tesla? Still an hourly time frame chart here. This right back above the 250.75 neckline of the head and shoulders, right? We were very cautious of this level in the pre-market prep this morning. Putting in bull flag consolidation into the afternoon session, the trade setup here is very straightforward. If we can get continuation, it's over 258.75. Intermediate target is here at 262.50, and then anything more constructive like this is where the doors really open up for the larger range. 276.75 will be the target over time. Bears, you failed on the move for a lower high underneath, so because of that, I'm not really looking for any bearish outcomes here in Tesla. Wouldn't be trading for the bearish outcomes. If something like this does unfold, then maybe we'll consider the gap into the future. It's just not there today with the price action, after today's close. Google, a little bit more complicated, right? Let's go to the daily chart here to make some illustrations. I need to check myself out of Google, and by that I mean not trade it, but just I need to be very aware of my own emotions. I was very wrapped up in the 122 level, you may recall from the pre-market live streams, and it's been just a whirlwind of a wildebeest back and forth ever since we've moved away from that. There have been some strong downside moves, but I mean, this gap and go, this big reversal back into the large red-bodied range on today's session, it's not the cleanest chart, especially with this really opening up the larger downside range. I think this is a patience play and waiting for it to set up once again, and two ways I can see that happening. If we do see continuation higher, 122 in my mind, has the opportunity to provide a lower high, very similar to the IWM overhead supply, right? So 122, I'll be looking for a daily lower high that does something like this. If that doesn't unfold and we stay in this range, it's a flush of the daily 50 SMA, and then an equal low breakdown in here obviously opens the door for this larger, more attractive downside. Under 116.50, 109.25 starts to come into sight. So being very open-minded with Google for this to flip back into the bullish territory, it's got to be proof of a higher low over the 122. So I'm checking myself before I wreck myself out of Google. What's going on with Metaverse and the fantasy land here? Just treat it as a balance range, very sideways, very barcoding. Inverted hammer today, if we take it down to the hourly, we can see that we are getting some price acceptance into the end of day, back into the original range here. So there's the possibility of a look above and fail. I wouldn't call it a double top yet. Obviously, a double top is only a double top when you break the neckline, and that's just the bottom of your daily balance. So 278.75, and then your upside is just these equal highs over 289.60. If that does break, remember that there's a lot of gap range to still trade for overhead. 307.50, you don't need to be the first one in the door. You can wait for a break, higher low retest above, and that would look very, very healthy on the daily chart, noting that we have four very, very precise equal highs back to back here that could use some repair, right? So be mindful of the higher low wanting to happen first, not just a sweep of those highs, then coming back down into range and then moving lower, right? So wait for the higher low above 289.60 is the main takeaway that's there. Let's take a look at NVIDIA, what's going on over here, just inside bars, so consolidating. I would say that this feels also maybe similarly to Google, like IWM. Here's your overhead supply. Notice the upper wick rejection from today's session, 421. Obviously, there was some bad news about the export of chips to China on today's session, or the pre-market, I should say. Really a sideways day. So I would be patient out of NVIDIA and wait for the inside bars to resolve on the daily time frame before taking, the next stab at NVIDIA, right? Anything that's just doing this has proven to us that you're not really going to get materialized moves out of it. It's a higher low back above 421 or a lower high underneath 401 out of NVIDIA. Microsoft, what's going on with Softy? Inverted hammer, kind of rejecting this right shoulder. You can see this more clearly on the hourly chart, right? We've been talking about this kind of deal over here, how this retest as it was pulling back, it wasn't really ideal for this zone, just like the Qs, two upper wicks rejecting that 338 level. So out of Microsoft, I would be more optimistic looking for the lower high back below 334.25 to trade into your downside equal low at 328.65. If we're just consolidating in here, I would be neutral and open-minded to the potential of a inverted head and shoulders. And then again, it's got to be a resolution of this range. Break, retest, higher low here, break, retest, lower high here for something more interesting to happen out of Microsoft. But I'm sort of carrying forward from the daily chart, more of a bearish bias with this inverted hammer and the overall possibility of a daily lower high. Last but not least, the mini beast, before a couple of trade ideas, and then I'll send you on your way. Inverted hammer rejecting the overhead gap, so 131.30. This is like, again, balanced as balance can be. If we take a look at the hourly chart here to illustrate this with a bit more nuance, it's not bearish yet per se, but it's certainly not encouraging for long. So what do longs want to see? At this stage in the game, after you get consolidation like this, right, it's a break and then move intraday that closes this gap, or it's just further consolidation. Ideally, we stay over 128.60. If you notice that we're getting a higher low here, that is, of course, bullish, building the case for an ascending triangle. If we get the retest of 127, it's not the end of the world. Just treat it as a balance range. We'll learn something if Amazon wants to do this back into the range under 127. So I think a lot of things are setting up after the Tuesday rally from the broad market. Now some things are kind of setting up for the next move. We'll see what unfolds. Kicking off our trade ideas is WFC, Wells Fargo and Company, and you've really got to tell yourself the story on this idea, right? So the gap down day here finds a hammer candle off of the daily 50 SMA, which is upward sloping, so great. When we break the hammer high, we're looking for continuation to close the gap and perhaps acceptance back through the thin structure breakdown in here. Notice the upper wick shows a complete rejection of that area, and we've closed weak on the lows, and ever since, we've really just been sideways stuck in this balance range. You could think of it as a bear flag, you could think of it as a head and shoulders like this. Doesn't matter what you want to classify it as. If we break down underneath 4040 roughly, the target should be these lows, at least as a scalp intraday perhaps, closer to 39.50. The options chain is not fantastic out of Wells Fargo, but it is easy to borrow and the price point is cheap enough. I would recommend just shorting the shares, not necessarily looking for big size on the put side of the option chain. Next up, let's take a look at Coinbase. COIN is the ticker over here. And the big takeaway here, once again, tell yourself the story. Remember that this was a prior pivot top. What was that pivot top protecting? Technically a gap from over here. If we extend that, the upper wick of today's bar looks into that gap above the pivot highs, gets zero price acceptance up there, and then closes weak down towards the lower third of today's trading range. If we take a look at the hourly time frame chart, flushing today's inverted hammer lows at 69. Go ahead and leave some laughing comments down below. Ha ha ha, so funny. If we flush it, we're looking at 66.25 as a target, where the breakout really stemmed from on the Tuesday session, right? So looking for a short under 69 out of coin, and we will play some downside there. The puts in this one tend to be decent to trade. Let's take a look at ORCL for our last trade idea. Oracle is up on the chopping block. Inverted hammer. Why is this one impressive? Because it's technically an engulfing bar. It didn't close outside of the prior day's range, but the upper wick looks above the top of the prior range. This bar looks into the previous range, closes weak on the lows. So overall, just not really thrilled with the buying activity that we see here. We are going impressively counter trend, so be mindful of that. But the reason that this one works in my eyes is because we do have thin structure to be gunning for underneath. Large gap from the earnings cycle, right? So underneath 116 really starts to make this interesting. You can see that this is where the consolidation structure was after the gap and go from earnings. Technically, your gap starts at 114.25, we'll call it for round numbers sake, and the gap closes at 110.15. So lots of downside room to run. You don't have to be the first one in the door. It might be worth being patient out of Oracle and making sure that the broad market aligns with this before we go massively counter trend to something that is clearly higher on the daily time frame chart. That's all I've got for you on today's episode of the Midweek Market Update. I hope to see you in the pre-market prep tomorrow morning at 8:15 and on the Friday session as well. We'll have some fun there going into the holiday weekend here. And with that said, I wish you a green trading week.